The endowment effect is a concept in behavioral economics that describes how people tend to value something they own more highly than the exact same thing if they do not own it. In other words, ownership increases perceived value. This means that once an object becomes part of our endowment, or what we consider ours, we become reluctant to give it up, even if rational economic reasoning suggests we should be willing to trade or sell it at market price. To put it simply, if you are given a coffee mug, you will probably demand a higher price to sell it than the amount you would have been willing to pay to buy it in the first place. The difference comes from the psychological attachment created by ownership. The origin of this idea comes from psychology and was formalized in economics by Richard Thaler in the 1980s. Thaler, who later won the Nobel Prize, used the endowment effect to show that people do not behave as perfectly rational agents, as assumed in classical economic theory. Instead, we suffer from cognitive biases. The endowment effect is closely related to another key idea, loss aversion, developed by Daniel Kahneman and Amos Tversky. Loss aversion means that losses hurt us more than equivalent gains please us. Therefore, giving up something we own feels like a loss, and we demand extra compensation to accept that loss. Now, let's look at some examples. Imagine you receive a free t-shirt at an event. At first, you might not care much about it, but once it is yours, if someone tries to buy it from you, you will probably set a higher price than you would ever have paid to purchase it. That is the endowment effect in action. Another classic experiment involves mugs. In one study, half of the participants were given coffee mugs, while the other half received nothing. Those with mugs demanded, on average, a much higher price to sell them than the non-owners were willing to pay. Even though it was the exact same mug, ownership distorted perception of value. The endowment effect appears in many areas of life. Home ownership is a great example. People selling their houses often overvalue them compared to market prices because their home is tied to memories and identity. This makes negotiations more difficult, as sellers demand more than buyers are willing to pay. It also plays a role in financial markets. Investors often hold on to losing stocks for too long because selling them feels like admitting a loss. They become attached to their portfolio, even if rational strategy would suggest reallocating. A curiosity is that companies often exploit the endowment effect in marketing. Free trials are a powerful tool. Once you start using a product, even temporarily, you begin to feel a sense of ownership. When the trial ends, giving it up feels like a loss, so you are more likely to pay to keep it. Similarly, in retail, allowing customers to test products or take them home before purchase increases the chance of buying, because ownership, however temporary, raises perceived value. Another interesting angle is how the endowment effect interacts with legal disputes. For example, in litigation, plaintiffs often demand more money to settle because they feel entitled to compensation, while defendants perceive the same claim as less valuable. The asymmetry in valuation complicates negotiations. The effect is not universal, though. Research has found that traders in markets, who are used to constant buying and selling, show weaker endowment effects. Their professional habits reduce emotional attachment to goods. This suggests that the endowment effect is not just automatic, but can be shaped by experience and context. In summary, the endowment effect is the tendency to overvalue what we own simply because we own it. It challenges the classical assumption of rationality, demonstrates the power of loss aversion, and explains behaviors in consumer markets, finance, and law. At the same time, it is a reminder that ownership is not just economic, but also psychological. Up there, I leave you more videos so you can keep learning law. Remember to leave us a like and subscribe.